Greetings, friends. Welcome to the second module of options pricing. In the first module, we discussed various Greeks, various factors which can affect the prices of the option. And in this module, we are going to cover two major option pricing models, binomial and Black-Scholes. So let's start. So the binomial option pricing model is an option valuation method developed in 1979. It is quite a simple approach, simple model which uses an iterative approach. And with the model, there are two possible outcomes with each iteration. Either the stock will go up or the stock will go down. So that's the simple idea around which this model has been built. So let's take an example. Assume there is a stock that is priced at $20 per share. All right, so this is the stock price. And you are looking at a call option which is going to expire in 3 months, right? So stock price you are assuming is going to jump $2 in the next 3 months, or it can go down $2 in the next 3 months. So same assumption you have to make for the upside and to the downside. And what you want to calculate is you want to calculate the price of a call option, which is available on for the strike $21. All right. So stock price $20. Strike price you are looking at is $21. And this is the assumption you are making. The stock will either jump $2 or will go down $2 in the next 3 months. So let's look how this option pricing model works. So this is our assumption. It will either go up to $2 or it will go down $2, correct? So now the whole idea of this model is you need to make a risk-free portfolio. Okay, so this is the objective which we are going to use as our first step in creating this model. Okay, so you can see this portfolio where you are going long on certain amount of shares, right? So this triangle is delta. Delta here is representing the fraction of share on which you need to go long. Okay, you need to buy those shares. And since this has gone to $22, this is the assumption we are making, right, to the upside. That means the option which you have sold on strike 21, you are now making $1 loss in it. Am I correct? Because if you buy a call option, right, and stock price goes up, you make profit. But if you sell a call option and stock price goes up, you make a loss. How much loss? The difference between the spot price and the strike price. So since you sold a call option on 21, now you have suffered a loss of $1. Okay. Now, second situation is if the prices have gone down to $18. Here again, we are making the same assumption that you're going long on a certain fraction of stock, correct? But here, when you sold a call option, right, you are not making a loss. Why? Because this option, which you have sold on a strike of $21, has become worthless for the buyer, correct? So it has zero value for you, or zero value for him, zero for you as well. So it is worthless now, correct? So now you have to find the value of delta. And how we are going to find it? Since we are talking about a risk-free portfolio, that means we are somewhere making an assumption that whether the market prices go up or market prices go down, it is not going to affect us because our portfolio is risk-free. That means this should be equal to this. So either prices go up or prices go down, we will not make a loss. So let's do that. We take the upside potential and compare it with the downside. And we are assuming that both should give us the right result. So we are doing this to find the value of the delta, the fraction of shares which we are supposed to purchase. So delta comes out to be 0.25. That means we need to create a portfolio where we are buying, let me put it in this way, we are buying 25% of one share and then we are selling one call. We are selling one call. Okay. So now, if this is the fraction of shares you need to buy, all right, your portfolio value is going to come out to be 4.5. Why 4.5? You replace delta here with 0.25, or you replace delta here with 0.25. You are going to get answer $4.5, correct? But this is the value of a portfolio after 3 months. So what is going to be the value of the portfolio today? So you need to discount it back, correct? So this is a compounding or discounting formula, correct? If I remove minus, this will become compounding. Since I'm discounting, I put minus here. So the value of E is 2.7183, right? What is R? R in our case is 0.25, 3 months. Oh, sorry, R is, what is the rate of interest we have taken? Sorry, I forgot. Okay, rate of interest by default, I'm assuming 12%. Okay, for this example, I forgot to put it here, 12%, correct? Multiplied by your time. So you will get your answer 4.367. Now the difference between this portfolio value 4.5 minus the present value of this portfolio is your option price. So that means if you are looking at an option at strike 21, when the spot price is $20, the right price for this option is 0.633. Okay, so this is just one step which I have done for binomial option pricing model. Similarly, from here you can move forward, right? You can go to $25 and then you can go to $15 and so on, correct? All right, now let's look at the Black-Scholes option pricing model, one of the most famous model used for pricing European call option. Okay, now BSM model is a differential equation used to solve for option prices. So that means we are going to use an equation rather than using this kind of iterative approach. This model was so famous that the creators of these models, they received Nobel Prize for it. So the standard BSM model is only used to price European option, and it does not take into account options like American options, right? The formula developed by Fisher Black, Myron Scholes, and Robert Merton is perhaps the world's most well-known options pricing model. But before we can talk about this model, we have to understand that this model has made certain assumptions. Okay, so what are these assumptions? The option is, first of all, European, right? And can only be exercised at expiration because it is not an American option. No dividends are paid out during the life of the option. To be honest with you, there is another version of this model where you can incorporate dividends as well. But the original model, which we are going to discuss, it made an assumption that no dividends are paid out by any stock which you are pricing for the option. So this company is not paying any dividend on that stock. Markets are efficient. Efficient means market reflects all the available information. That means no one can predict the market movement. That, logically saying, it basically means that unless and until a new information hits the market, market logically should not move. So no one should be able to predict the market because no one is in a position to predict the information. There are no transaction costs in buying the option. The risk-free rate and the volatility of the underlying are known and constant. Please relate it to the module 1 where we discussed about Greeks. You are going to see that all the Greeks are going to play a role in this option pricing model. The returns on the underlying are normally distributed. Why we need this? Because we are going to use the Z-score table as well. Okay. All right. So let's have a look at this model. Do not get boggled by the look of the formula. Uh, I'm going to explain the logic behind this formula, and that will make it simpler for you to understand. Okay. Now assume that this is what you are going to, sorry, this is what you're going to get, and this is what you are going to pay. Okay. So what you are going to get versus what you're going to pay. Now S is stock price, right? And this is cumulative probability distribution function. We are going to use Z-score table to find the score. Okay, just assume this is probability, all right? Probability of this happening, that we actually going to enter into this trade. This is the strike price, And this is again just like binomial model. We are discounting back the strike price to arrive at its present value. And this is again the probability of this happening. All right. Now D1, this function, and D2, we need to calculate first. So first we are going to calculate D1. So this is a log normal function of stock price divided by your strike price plus the market interest rate plus the volatility, that is the square of your standard deviation, and your timeline. Correct? So you see all the Greeks are here. You have spot price, you have strike price, you have interest rate, you have volatility, and you have time to expiration. Right? Now, the whole thing you need to understand is that if you increase the volatility of something, because see, rate is given to you, you know the interest rate, whatever interest rate is there in your economy, you know which time frame you are looking for, 1 month option, 2 month option, 3 month option, you know the spot price, you know the strike price. These are available things. Volatility is something which is kind of an assumption which you are making, but our assumption can also go wrong. But for the time being, just for our understanding, assume that volatility goes up. So if volatility goes up, if you remember from module 1, if you increase the volatility of something, its option price should go up, correct? Because now seller is feeling more risky in this transaction, so he wants more premium. Now look logically at this formula now, right? If volatility increases, that means this portion goes up, then D1 goes up. But D2 does not go up to that level. Why? Because D2 is D1 minus this number, okay, minus the volatility, correct? So D2 will go up, but not up to that level. So what you are getting is going to increase, let's say 20%, but what you are paying is going to increase only by, let's say, 10%. So if you see this minus this, what you get minus what you pay, your call option should go up in value. So you see the volatility goes up, your call option price will go up in value. Now let's look at an example. Let's say there is an investor who has the opportunity to purchase a 6-month call option for $7. Our objective is we want to price this call option and figure out whether this price of $7, which is available in the market, is this right price or not? Should we buy this option or not? Okay. So we have your spot, we have our strike price, we have our risk-free interest rate, and we have volatility of the stock. All we have to do is now plug in these numbers. We will get D1. Similarly, plug in the numbers in the D2 formula. We will get the D2 number. Use the Z table to get your ND1 and ND2. Okay. So ND1 will come out to be 0.536, ND2 will come out to be 0.420. And back to the same formula, your spot price multiplied by ND1 minus your strike price multiplied by your ND2. So your spot price, which is 75, multiplied by your ND1, which is 0.536, minus your strike price multiplied by your ND2, which is 0.420. Okay. So this is the number which you are going to get. So that means this option should be priced at 8.23. The market is charging us what? $7. According to us, it is far more valuable, so it makes more sense to purchase this option. All right, so in summary, an option's value increases or decreases depending upon different variables: spot price, strike price, time to expiration, volatility, market interest rate. Each has its impact on the option price. The binomial option pricing model values option using an iterative approach, step by step, right? Up, down. And Black-Scholes model is a differential equation used to solve for European call option prices. So that's it. I hope you enjoyed this training, and I hope again to see you in our other trainings as well. Thank you so much.